Greetings everyone. Sorry for the late one. I'm a bit late. I'm sure you guys have been in the waiting room for a while. I saw Ibra coming early. So Alex Oshira, hi. I hope you're well. Alexi, Bosco, Ibra, Koech, Mondi, Mudhoni, Victor. I hope you are all doing well. So today we've decided to change a few things. So we're starting our Zoom, not our Zoom, but our live webinars in partnership with Pepperstone. So every Monday, most of the Mondays, we'll be having such sessions whereby we'll just be tackling all about trading. For today, I'll be starting and I'll be doing risk management. So for those who have been my students, I'm sure you will relate to what I'm going to share today. For those who are not my students, who have not yet been my students, you'll learn a thing or two today about risk management and how we view risk here at Financial Hub. So it's mostly about the risk management framework that we need to develop for our systems. Just a minute, let me admit other people here. Okay. Yeah, so today we're going to talk all about risk management, and as I said on the topic, it will be about how to find the ideal risk-reward ratios you need for your system, and also how to find the ideal number of trades you need for your system for you to meet your objectives. So most of the traders, they trade without understanding this part of it. You need to do it mathematically. We call it statistical analysis. So you need to develop a statistical method that will prove to you mathematically that for this number of hit rate, for this number of trades, for this number of risk reward, I can be able to meet my objective, and what I can twist maybe if I want to change a few things. So I'll go straight into the charts. Sorry, not the charts, but my presentation. So I'll go straight into it. So risk management, this is I think the second one I'm doing. I remember I did one back in 2020. So it's been a long while. So starting off, basically, what is a risk management framework? So the risk management framework is a step-by-step process that involves a good understanding of the basic parameters for measuring risk. I'm not sure if we've started too early. Maybe some people are still joining. I can say a lot of people are still joining. So we'll just continue though. So risk management is a step-by-step process that involves a good understanding of the basic parameters for measuring risk, controlling risk, and also mitigating the risks we face in the market. So trading is heavily risky. A lot of people lose money in the markets. Statistically, it's about, I think, 80% of traders end up blowing their account in less than 90 days. So it's because they don't have this statistical analysis done for their systems. So today we're going to look at some numbers. It's going to be heavily mathematical. So you need to have your numbers right and your math right. So basically, the risk management framework helps us create a hypothetical system from backtest. Then we can now use it moving forward on the forward test. And it helps us gauge the expectancy of our system. Basically, expectancy of our system in terms of does the system make money at all? So one of the most important concepts that is required for us to understand deeply is risk to reward ratio of every trade setup, and the relationship between hit rate, risk reward, your risk per trade, your objectives, and also finally how do you position size. But for today, we're going to majorly focus on hit rate, risk reward, risk per trade, and objective. I won't go into position sizing today, but I'll do another full webinar on now how to position size correctly. Also, Pepperstone right now has the trading view feature. It helps us position size easily, unlike MT4 directly. So today we're going to handle the rest apart from position sizing. So we'll start with risk reward ratio. I'm sure most of my students here know, familiar with this because we've done this with them. So the risk reward ratio. So what is risk reward ratio? Basically, risk reward is the measure of potential reward or profit that a trader or investor can expect from any investment in terms of potential risk of loss. So basically, we calculate your risk, and also we look at what reward are you expecting for the risks you take in the markets. Of course, if you are taking risks in the market, you have to be compensated for the risks you're taking, and that now comes in terms of the reward. So in trading, risk goes hand in hand with the reward. You can't separate those two. So you have to understand, if I'm risking $1, how much am I expecting to make? So for example, if a trader is risking to lose about $20 on a trade, and the profit target is about 60, that is 20 to 60, or simplified 1:3. So basically that is the concept of risk reward. What risks are you taking, and what are you being compensated for taking those risks? So that is I think, if by researching at many good traders, from reading books like Market Wizards, you can notice the importance of risk management. Most of them will always say risk management is important. Utilize risk reward to your advantage, because maybe we don't have the best hit rate to be able to cover for our losses, but our risk reward basically is what will help us cover our losses. So on TradingView, this is always the setup. So this side is the risk side, and this the blue side is the reward side. So for this, you can see it has a risk reward ratio of 2.5. Basically, for every $1 I'm risking, I'm expecting to make $2.5 on the trades I'll be taking. So this is just a setup on TradingView. I'm sure most of you use TradingView, and you can relate to that. So we'll start first of all with risk reward and hit rate. So we look at the relationship between risk reward and hit rate for us to be able to meet our objective. So the relationship between hit rate and risk reward ratio is what determines if a strategy will be profitable. Let's look at an example. So trader 1, this is trader 1, an example of a trader who is losing with a high hit rate, eventually with a high hit rate. He has a high hit rate, but a very low risk reward ratio. So hit rate is 60%, winning about 60%, but the reward is inverse. That is what we call inverse risk reward, or asymmetric risk reward. Basically, they are risking $3 for a dollar, or 3 pips for a pip, in terms of the wins. So this is counterproductive. Such a system can't make money, even if it's winning more. And one of the reasons for this happening is because traders actually don't understand the concept of risk reward. There is the concept of initial risk reward, and now there is actual risk reward. So initial risk reward is what we traders take before we place the trade. So we have a trade setup. Maybe we're aiming to get a 2.5 risk reward, but eventually, as we trade, maybe we were aiming to make 60 pips by risking 20 pips. That is 1:3 risk reward. But as the trade goes on, you find that most traders will tend to tweak their trades, and they will most times tweak their trades when they are winning, but not when they are losing. So when they are losing, they are not tweaking their trade. They take the trade to full stop loss. But when they are winning, they can easily cut trades. You find someone initially is aiming for 100 pips, but they take maybe 20 pips eventually. So if you're taking 20 pips and you had risked 20 pips in terms of stop loss, that means you've basically taken a risk reward of 1:3. If you take anything less than that, you're even taking now the inverse risk rewards. Basically, you are risking more than what you're expecting to make in terms of a reward. So for this case, for this trader, let's assume he's taking 10 trades, winning six times, $10 each. So that is a total win of $60. But for the 4 losses he's taking, he's losing $30 on each trade. So the outcome will be, of course, for the losses it will be $120. For the profits it will be $60. So outcome, eventually the trader is down $60. So this is why it becomes very difficult for you to win in the markets when you're having inverse risk rewards. So the point is, we need to balance between risk reward and hit rate. Both of them need to make sense. Let's look at trader 2. So trader 2, this trader is now winning with a high risk reward and a low hit rate. So the hit rate is not, compared to the first person, a 30% hit rate, but the risk reward is 1:3. So now this is the good risk reward that we always advocate for, and not the inverse risk rewards. So 10 trades, 3 wins of $30 each, that is a total of $90, and 7 losses of $10 each, so negative $70. So when you do the math, 90 minus 70, the trader is in profits by $20. So we can look at trader 1 lost money due to poor risk reward, despite having a good hit rate. And you'll find they're having a good hit rate because they take a lot of their profits before they hit their objectives. So they have many wins but small wins. So losing 3 times what he makes. Trader 2 made money with a bad hit rate, but a good risk reward ratio. So that balance between risk reward ratio and the hit rate is what a trader needs to find. And now today we are going to, because most times you will find your hit rate from your backtesting, But even as you backtest, you need to look at what risk reward ratio do I need for me to meet my objective. So let's say you have a 10% objective per month, maybe a 20% objective per quarter. How many trades do you need, and how much risk reward do you need to take for you to be able to meet your objective? And even if you miss your objective, you know, okay, if I take less risk rewards, I can miss my objective by this percentage of So we're going to look at now, this is now the meat of the topic for today, how to find the ideal risk reward ratio and ideal number of trades for us to meet our objective. So we will use some risk parameters that I will share with you guys, for us to be able to look at the statistics that we need to develop. So while creating a risk management framework, there are data that we will need to have and see mathematically if the system over a number of trades will make money and actually meet our objectives. So such numbers are risk reward, number of trades needed, hit rate, risk, and also the objective. So this is basically risk per trade, and finally your objective. So we will focus on a 3-month trading period to judge the validity of the system. So 1 month is not a really a good number to get the validity of a system, but at least in 3 months maybe you can start. It's a good point to start. So here are some of the risk parameters. So we'll be using a $1,000 account because that is a good number that most people can afford. It's not a good number actually in terms of capital, because in trading we need huge capital, but $1,000 is where most people can start out if they save well, or if they are willing now to take this full time. Our objective is to make 20%, so this is in 3 months. So we are aiming to make 20%, which is $200 in 3 months. Maximum risk per trade is 1%, so that is $10. Number of trades. So for the first scenario, we'll be looking for the average risk reward. So we have the number of trades, but also for the second part of it, we will have the risk reward ratio, but now we won't have the number of trades. So we'll be doing those two a bit differently. Also for risk reward ratios, we will be using 3 variables. So a trader who has a 20% hit rate, another trader who has a 40% hit rate, and another trader who has a 50% hit rate. We will now look at what is the average risk reward for all these people. So trader 1, trader 2, and trader 3. But for the number of trades, we will look at how many number of trades do we need for a 40% hit rate. So we'll start directly with trader 1, and remember we are trying to find the ideal risk reward ratio for the 20% hit rate. So the ideal risk reward setup will mostly depend on the trader's system, which is hit rate and objective. And objective. And our goal here is the same: to make $20% in 3 months in 30 trades by taking 1% risk per trade. So going swiftly into it. So trader 1 has a 20% hit rate. So out of 30 trades, 20% hit rate basically is 20% of all the number of trades. That is your wins. So that is always what we mean by 20% hit rate. Basically, if you're winning, an example, out of 10 trades, if you win only 2 trades, that is a 20% hit rate. But here now we have 30 trades. So what is 20% of 30? 20% of 30 is 6. So those are the winners they have. So they have 6 wins and they have 24 losses out of 30. Expected return is $200. So $200 is the expected return. And we know this trader is losing 24 times. Losing 24 times by risking 1%, that means you're down. And 1% is $10, so you can do the math. That is 24 trades times $10. So that gives you your total losses. So we know our total losses is $240. Basically 24 times 10. That is $240. Our total wins is 440, but how do I come to get 440? Basically, I need to cover my losses for me to meet my objective at the end of the month, at the end of the quarter, I mean. So if I'm having 240 losses already, how much more should I win for me to be able to cover my loss and still make $200? So you simply add $200 to your loss now factor in the loss as just 240, not negative 240. So basically I need to make $200 and still cover my loss of 240. So that is 240 plus 200. That is now 440. Basically, if you do 440 minus your losses 240, you get your expected return of $200. So total wins is 440. We know our single loss is $10, that we know from the risk per trade. What about now the single win? So I need to make $440 from the 6 trades that I win here. So 440 divided by 6 trades, that brings me down to one single win should be an average of about $73.33. So if you do the risk reward ratio now, basically take risk, your risk is $10 and you expect to make $73 on your wins. That is simplified 1:7.33 risk reward ratio. I know for some systems they have this risk reward ratio, they can easily attain such risk reward ratios, but for me I always find it difficult to get big risk reward ratios on 30 trades. So maybe you can get maybe some of them, maybe a trade a week or a trade even a month. But remember here we need to get 30 trades which have a 1:7.33 risk reward ratios. Again, I'm not saying it doesn't work. Some people have risk rewards ratios of 1:10, 1:20. But from experience trading and also for my colleagues here, I think most of us, we have risk reward ratios between 1:2 to 1:4 or 1:5 maximum. For I think Caleb sometimes has such risk rewards ratios of 1:5. But for such a system, I always say it's a system that needs some improvement, basically in terms of hit rate. A 20% hit rate will give a trader a lot of psychological challenges, because in trading, traders are not designed, okay, not even traders, but in life, you're not designed to take losses. So if you find that your system already in itself is giving you a lot of losses, it will be psychologically challenging. Most times you will find yourself maybe revenge trading, and also it shows that your system is not, like, you're not really good at selecting trades. So I always say for a 20% hit rate, we need to improve it. It's not a system, for me personally, I can't for test a system that has a 20% hit rate. Basically, I can't put money on it until I improve it to at least maybe 40%. So we look at, basically there's some ways of trying to improve your hit rate, and number one is cutting down on the number of trades you take, and being selective, exactly, like being selective on the trades you take per day, per week, per month, even per quarter. So if you increase more on being selective, you can now easily maybe find a better hit rate. And a better hit rate, of course, will allow you to now lower your risk reward ratios, and you will still meet your objective. So we can see this trader has to struggle for 1.733 risk reward ratios on 30 trades, which I personally believe is not an easy task. So we'll find this trader is trying to justify some of bad trades and just taking them because he needs to find 30 trades with very big risk reward ratios. So I always say for such a system, a 20% hit rate system, you need about one, and this is minimum, 1:7.33 risk reward ratios. The moment you take 1:5, 1:4, you will miss out on your objective. Maybe if your objective was to make 20%, you'll find that month you've been able to make, let's say, not that month, but that quarter, you'll have maybe made about 10% or 15%. So you need to know, what do I need to adjust? So do I need to adjust my objective or reduce it maybe to 10% or to 15%? And maybe I can get now a lower risk reward ratio, maybe 1:4, 1:5, which can be found sometimes. Even I'm sure for Caleb, he does not get a lot of 1:7, 1:5 risk reward ratios very frequently. So such trades might just make a trader do a lot of justify a lot of bad trades that should not be justified. So let's look at the next trader who has 40% hit rate. So this trader has improved by his hit rate by almost 100%, from 20%. Now they are 40%. So 40% of 30 trades, again, we get our wins, which is 12 wins, and of course 18 losses out of 30. So expected return is the same, $200 again. Total losses, we are losing 1% per trade for 18 trades. So that is a total loss of 180 trades. So again, same concept. How do we get our total wins? We get our total wins by adding our losses to our expected return. If I've already lost $180 and I need to make $200 at the end of the quarter, so how much did I make on my wins? So that is 200 plus 180, it comes to 380. So you can notice, if you now minus your losses from your wins, you get your expected return again, which is $200. So here again, we know I'm winning 12 times, and I'm winning 12 times, then this 12 trades needs to give me $380. So I to get a single win, I basically divide 380 divide by 12. That comes to about $31.67. Remember, for the other trader it was about $73.33. So for this I only need to win on average per trade about $31 or $32. Of course, risk to reward ratio, $10 is to 31, because this is my risk, this is my reward. With a system which has a 40% hit rate, I can comfortably attain my objective by having a risk reward ratio of 1:3. So you can see you've cut down your risk reward ratios compared to the first trader who has a 20% hit rate. Now with only 1:3, which is very, very attainable, very, very reasonable, you can easily make your 20%. So you don't need to have your TP so stretched out for you to get big risk reward ratios. So a 1:3 risk reward ratio can work. Even if you take less than that, maybe you will also fall short of your target, but at least it's very, very attainable. Many systems have actually a 1:3 risk reward ratio. So that is for a trader who has a 40% hit rate. So as you improve your hit rate to 40%, a trader now needs a lower risk reward ratio of 1:3, which is easy to attain. So I always believe, don't focus on forcing big risk reward ratios. Focus on improving your hit rate, and your system will automatically work even with a lower risk reward ratio. So that is 1:3. So of course, for that, we know for the next trader with a 50% hit rate, they actually now need even less than 1:3, of course. But let's get to that. Let's look at the 50% hit rate. So averagely, if you backtest well your system, if you work well on your system, if you spend the time to improve your system, I believe a 50% hit rate is not very, very difficult to attain. And now that will allow you to even have way less risk reward ratios. So same concept, 50% hit rate. That means I'm winning 15 trades, I'm losing 15 trades. My total losses, of course, $10 times 15 comes to about $150. Again, for me to meet my objective, after losing $150, I need to add $150 to my objective, which is 200. So I need to make $350 on the 15 trades I take. So $350 on the 15 trades I take. Of course, our single loss is $10. Consistently, we've been having that 1% as the single loss. So single win, 350 divided by 15, that brings us now down to $23.33 per trade on the 15 wins that you make. So for this risk reward ratio, again, 10:23, that is simplified as 1:2.33 risk reward ratio. So you see, for all this, most traders start trading and they have not done the mathematical framework to understand, okay, what is the average risk reward ratio that I need for my system to meet its objective if I have a certain hit rate. So I always believe it's important for every trader to, if you know your average hit rate, you can now focus on understanding the ideal risk reward ratios for your system, for you to know what objective you will be going for, and also what risk reward you will be looking at for in the markets. So you find that if you don't do this, if you don't know mathematically, sometimes maybe you can be missing out on your targets, but you don't know the root cause of why you're missing out on your targets. You've just put your a target on yourself, but you don't know what rewards do I need for every risk I take for me to be able to meet my objective. So this is very, very important. I believe for all the traders that have passed through my class, they really do appreciate that they get to now know which risk reward ratios they will be looking at for in the market. So that is very, very important to always do it mathematically. Always just don't guess or just don't use any risk reward ratio. And don't use any risk reward ratios that you've not yet done mathematically to understand, okay, if I use this risk reward ratio, I can attain my target. If I take a lower risk reward ratio, maybe I can miss on my objective by this margin. And you can also, I don't know who is that, not on mute, but anyway, so I think now you can see for the three types of traders that we have: 20% hit rate, 40% hit rate, and 50% hit rate. The lower your hit rate, the more you will struggle because you will need to find very, very big risk reward ratios, which can sometimes, market can even make a 1:4 risk move, but your target is still 3% out of, the 1:4. 1:4 is a big market movement. So you'll find actually sometimes markets are reversing on you. You had some good wins, but markets are reversing because your TP is too far-fetched. So I always say use a risk-reward ratio that allows you to have an objective target, an objective a TP placement. So if you put your TP too far away, most times you'll get your trades are working, but they are not working 100% because your TP is too far compared to the risks you're taking. So I always tell traders to always improve. Maybe the worst, maybe 30% can also work. Maybe you'll need a 1:4 risk-reward ratio, or 1:4.5. You can do that on your own, because I'm sure maybe you've understood the concept. So try and juggle around the numbers. Try and do it for yourself and understand, okay, if my hit rate is 60, what is my average risk reward? If my hit rate is 25, what is my average risk reward? If my hit rate is 30%, what is my average risk reward? Exactly, for you to meet your objective. And I always say here there's some things which we can adjust and some things we can't adjust. Things like hit rate, you can't just adjust your hit rate as you want. It's a work in progress. You take time to improve your hit rate. But there are things like our objective. Our objective, we can always tweak it. So we can always tweak our objective to, okay, if our objective was to make 20% and I know it needs me to have a 1:7 risk reward, what if I cut my objective by half? What if I put a 10% target per quarter? Of course, that will lower your risk reward ratios now down by also half. So if you're aiming for 1:7, maybe 1:3.5 now can work. So there are things you can always adjust, but there are things also you can't also adjust. Also things like number of trades. You can't just adjust the number of trades. It's for the markets to give you the correct number of trades that you take for your system. Basically, you've backtested the setup, the pattern. You know, averagely from backtest the pattern occurrence frequency, I know my pattern occurs this number of times. And if I use this risk reward, if this is my hit rate, I can easily attain my objective. So that is on finding the ideal risk reward ratios. So I hope it will help all of you try to find the ideal risk reward ratios you will need for your system, because I'm sure most of you have an idea of your hit rate, but maybe the challenge of missing out on your objective is also too high. So you also need to know why you are missing out on your objective, and most times it's because you don't know mathematically which risk reward ratios you will need. So that is on finding risk reward ratios. Next we will look at now finding the number of trades we need for a system, and for this I will only do for one person. So not even for the 3 people, I'll only do for 40% hit rate. So I think that will be easy. Yeah, here it is. So 40% hit rate. So we have almost similar concepts. Account size is $1,000. Objective is still 20%, which is $200. Maximum risk per trade is 1%, so that one we have. But now we don't know how many trades we need to find for us to meet our objective. So that is also something we can calculate, and we can find the average number of trades we need for us to meet our objective. Because if you don't know that, sometimes maybe you can be over trading. Maybe you're taking 50 trades and your system only needs about 20 trades for you to meet your objective. Sometimes maybe you can be taking less trades, or maybe avoiding some trades, but you need to take those trades for you to be able to attain your objective. So also we'll have a risk reward ratio of 1:3. So 1:3 risk reward ratio. So here we know our risk reward ratio, but we don't know the ideal number of trades we need for us to make money. So for us to basically to meet our objective. So hit rate is 40%. So same thing. So number of trades we don't know. We don't know the number of trades. So let's put the number of trades to be X. So let's put the number of trades to be X. Then we will move on from there. So I hope I won't confuse you so much with the X, but it's a simple concept. Of course, we know how we do find our hit rate and the number of trades. So initially, when we had our hit rate and number of trades, basically we'd multiply our hit rate times our number of trades. So same thing we'll do here. Our wins, basically, which is our hit rate, is 40%. So 40% of X is 0.4X. So that is 0.4X, and losses will be 0.6X. I think that concept is easy. So 40% of X. So 0.4 is just basically 40%, and 0.6 is basically 60%. So I'm winning 0.4X, and I'm losing 0.6X. Back on the wins, you can see I have total wins, which is 12X. How do I get that 12X? Of course, I know my risk reward ratio. So if my risk reward ratio is 1:3 and each loss is $10, that means each win is $30, right? I think that is also clear. So $10 for $30 win. So of course I'll multiply my total wins times 30. So 0.4x times 30 brings me down to 12x, and 0.6x times 10 brings me to 6x. So this is my total wins, and this is my total losses. So how do I find my number of trades? Of course, 12x, you minus your losses, gives you your objective. So that is always how we find our number of wins. Sorry, our number of trades. So number of trades is x. Wins, as I said, 12x total wins. Losses, 6x. So win minus loss gives us our objective. So 12x minus 6x should give us $200. So 6x equals to $600. X equals to 33.33 trades. So I hope it's not very, very difficult. I'll move back and repeat the same concept again for us to understand deeper. And I'll start here at x. I think this is where most people might not get it easily. So number of trades is x, and my hit rate is 40%. Basically, I'm winning 40 times of that x. So that is 0.4x. Each win is $30. Each loss is $10. That is 1:3 risk reward ratio, which is here. So if you have your average risk reward ratio, and you know in terms of monetary value, each loss is $10 and each win is $30. So that is 10:30. So multiply your wins, 0.4x. This is the number of wins times average win, which is $30. So that is 0.4x times 30 gives us 12x. Our losses, 0.6x times 10, which is the total, not really total, but risk per trade. So I'm risking only $10 per trade, so that is 0.6x times 10. So that brings me to 12x. I know if I minus my losses from my wins, it should give me my objective, which is $200. And that is why now we come down to minusing $6 from 12 to give us our objective, which is $200. 6x equals to $200, so basically x equals to 33.33 trades. So if you have a system which has a 40% hit rate and a 1:3 risk reward ratio, your system basically needs to generate about 33.33 trades per quarter. Remember, we said this is in 3 months, so that is an average of about 11 trades per month. So that is how you come down to seeing how the number of trades you will need for your system. So sometimes you can find your system does not meet its objective, maybe because for that month you are supposed maybe to take 11 trades, but markets did not offer you the 11 trades, because of course we also can't control markets to give us the number of trades we want, but at least we know the ideal number of trades that we need for us to meet our objective. So that is 33.33 trades. So most times, of course, we can't force, as I said, we can't boss the market. You have to pick what the market gives you. So if the market gives you 33.33 trades, you're well and good. If markets give you less than that, maybe you get 20 trades, okay, for this month, since I didn't get the average number of trades I was expecting, I know I can miss on my target by this margin. Of course, if maybe your system gives you 15 trades, you can miss your 20% target maybe by half. So maybe that quarter, maybe you made 10% return. So that is always how we try to help people formulate their risk management framework, not just through guesswork or just picking random risk reward ratios. So you need to know on average. Also, I didn't say that all your trades needs to have that a fixed risk reward ratios. Sometimes risk reward ratios can range. It's always a range. Like for me, my risk reward ratios are about 1:2 to 1:2.5. For Caleb, I think it's about between 1:3 to 1:5. So it's always a range, but I know if I put my risk reward ratios within this range, I can easily attain my target or even surpass my target. So traders, that was what I wanted to deliver to you guys today. I hope I have helped a couple of you people, and I want to actually see you guys putting this into action, finding your risk reward ratios mathematically, finding your ideal number of trades mathematically, and not just through guesswork. So this will help you understand why you miss on your objectives some months, and know why some months you are able to meet your objective and some months you are not able to meet your objectives. So of course, if you miss your objective, you can now go back and write it down and say, okay, I think I missed my target of 20% per quarter because for that quarter maybe I got only 10 trades. Of course, we always say move with what markets gives you. Don't force trades, don't force risk reward ratios. If markets cannot give you this number of trades per week, it's okay to miss on your targets. Trading is not a 9-to-5 job. No one has promised you any return at the end of the month, but it's always good to work with objectives. But also, if you miss your objective, just know it's because of this and this and this, and now that will help you moving forward. Of course, if you miss your objective because of a poor hit rate, you know what to go and work on. If you miss your objective because you maybe you're having a less risk reward ratio, maybe 1:1.5, 1:1, you know, if I improve my hit rate, my risk reward to maybe 1:4, I can easily attain my objective. And all this boils down again to going and backtest it. So you need to go and backtest, okay, mathematically I need 1:4 risk reward ratios. So go and test it and see if you actually make money on backtest first, then you can now finally come and do it on forward test. So I know most of you guys maybe were expecting I will do position sizing, but that needs a whole session again. So I will be doing probably in the next 3 or 4 weeks, I'll come back again and do on how now to position size objectively for you to also meet your objective, because also position sizing is very, very important. You can have a very, very good risk reward ratios, you can have very, very good hit rate, but if you do not position size accordingly, you will easily again miss on your objective. So all these things are always in one basket, they can't separate, but I'll just do that one separately for the position size. So I think I'll stop there.
Thank you very much for watching Financial Hub's content on YouTube. For more Forex analysis, financial education, podcasts, and exclusive content, be sure to subscribe.